the PMIs are pretty terrible. Do we think that Europe is headed for a double-dip recession? And if yes, did Christine Lagarde do enough yesterday to reassure the market?
Well, Alex, clearly Europe is in a double-dip recession. I think that's the message from the PMIs. That should not have been surprising. That was actually expected, given the lockdowns and the intensification and the tightening of the lockdowns that we have seen around the turn of the year. These lockdowns in most countries will likely stay in place for another 1 to 2 months. So this means a first quarter economic activity is likely to contract again after a small contraction in the fourth quarter. So yes, we are in a double-dip recession. This recession is not as deep as the one last spring. And we think that as the vaccines are being rolled out during the first half of this year, and as more fiscal support is coming, and as the ECB keeps being supportive, you should see a turnaround and you should start to see the economy picking up quite significantly from sometime in the second quarter or middle of the year at the latest.
Joachim, do you think Lagarde made a tactical error yesterday? She talked about the potential for not using the full envelope of the PEP program. That seems to me to be an opportunity for the market to test the ECB's resolve. At what point, for instance, on BTP yields, will the ECB step back in again? Why didn't she simply say, we're here in size, almost going kind of Draghi, we'll do whatever it takes? Because we're still in that kind of environment, aren't we?
Well, Guy, I think she didn't make a tactical error yesterday. I think she just repeated what has been said before. The envelope is there. It does not have to be filled totally if necessary. And I think she was very clear in emphasizing that the ECB's focus is not on achieving a certain fixed pace of purchases, of asset purchases per month, but the focus is on keeping financing conditions favorable for the Eurozone. And at times, this may require a stronger pace of purchases, and at times it may not be needed that they purchase at the same pace. So I think she just repeated what the ECB has said before, very consistent communication. And I think the market reaction overall yesterday was very subdued. And I think that confirms that we really didn't hear anything new from the ECB. The ECB is here to keep financing conditions favorable, and it is engaged in what we would call a form of loose yield curve control. So any major backup in yields, particularly in peripheral yields, I think will be met with a larger pace of purchases. But so far, this has simply not been necessary.
The story, for a broader look, I'm wondering how you view the vaccinations and then the corresponding growth potentials. I mean, in some ways, UK assets have been outperforming because the vaccines are getting out more. President Biden now with the stimulus potentially, you could see the US really outgrow Europe. There's delays in the vaccination distribution to different countries in Europe, also creating some more inequality within regions. How do you view the correlation between all of that?
Yeah, I think it's going to be a very uneven recovery. Well, at the moment, the recovery hasn't really started in Europe yet, but once it starts, it's going to be uneven for the reasons you mentioned. The main reason is different paces of the vaccine rollout. The same is true if you compare Europe to the US. In the US is further advanced on the vaccine curve, so they've a larger share of the population has already received at least the first shot. So it's out of the starting blocks earlier. Also, it looks like we'll get a significantly larger fiscal stimulus, additional fiscal stimulus in the US than in Europe. I mean, in Europe, fiscal policy is still supportive. And importantly, we'll also get the EU Next Generation Fund, the recovery fund, dispersing money in the course of this year. So this adds to the national fiscal stimulus. But by and large, the US stimulus is significantly larger, particularly if an important part of the Biden package, the 1.9 trillion, actually gets through Congress over the next few months. So you should see a much more vigorous economic recovery in the US in the course of this year than in Europe. Actually, the growth rate in the US could well be, the GDP growth rate could well be more than twice that of the euro area this year. So we could get close to 7% growth in the US. Euro area is more likely to be something in the order of 3, maybe 3.5%.
Yeah, that feels consistent with what Germany was saying about its economy today. We saw that downgrade come through. I read the note that you put out with Andrew, the cyclical outlook. And at the bottom of the first page, the last sentence, this is not a time for excessive optimism. Do you think we are seeing excessive optimism in certain asset classes at the moment?
Yeah, I think we are seeing some excessive optimism. I mean, there are good reasons why financial markets have done well, why equities have rallied into the new year, the vaccine rollout, the expectation of a fairly decent economic rebound this year, fiscal and monetary policy supportive. So there are reasons to be optimistic, but I think we have been starting to see some signs of excesses. It seems that everybody has the same view that we'll get a very sharp snapback in activity. And I think many investors may be underappreciating the remaining risks out there. And if you look at today's market moves, we had a risk-off move. Reality is setting in that the vaccine rollout is maybe not as fast as expected. There are risks around the virus mutations. So I think markets are waking up a little bit to the remaining risks out there. So that's why we say this is not a time for excessive optimism. It's a time for optimism, but bounded optimism, I think, describes the outlook better than excessive optimism.
Where does that then leave the dollar? There's a lot of disagreement over which side of the smile the dollar is going to be on. More issuance, more stimulus, weaker dollar, better growth, better vaccination, stronger dollar.
Yeah, so I think you'll see on and off moves. I think the general trend this year will be for some further dollar weakening. I mean, we saw a lot of this already last year. The basic idea is, and you've mentioned the dollar smile, so when the world is doing better and we expect the world to recover in the course of this year, that's usually the time when the dollar weakens. But on and off, you will get these moves where the dollar strengthens as we get more market volatility. So the dollar still is a safe haven. So whenever you get a risk-off move in markets, the dollar tends to strengthen. And I think you'll see these bouts of dollar appreciation in the course of this year. But the underlying trend, we think, at least for this year on a cyclical horizon, next 6 to 12 months, is for some further dollar weakness. And again, the main reason is that we expect the global economy to recover in the course of this year.
Joachim, where do you expect the fiscal impulse to fade first, and what impact will it have?
Yeah, so I think fading fiscal impact, you'll see that first in China, which obviously is the economy that has grown faster than the rest of the world over the last 12 months. They came out of their recession earlier. We're seeing something like 8% GDP growth in China this year. Momentum into the year has been very strong. The fourth quarter had very strong growth rates. So I think in China, you're going to see some credit tightening in the course of this year, led by the fiscal authorities, of course, but also by monetary policy and by credit policies. There are some signs that credit growth is already slowing in China. So you could argue the credit tightening has started, and we would expect to see some more of this in the course of this year. Now, obviously, they don't want to overdo it. Yes, they are worried about potential bubbles. They want to make growth more sustainable longer term. So the overall policy goal is deleveraging. They don't want to do it too aggressively, but there is a risk of policy mistakes. China is a $14 trillion economy, and it's highly leveraged. So there is a risk of over-tightening in the course of this year. So I think that's the spot to watch if you think about global growth dynamics outside of the US and Europe.